Hey traders, Roberto here. This lesson, Pro Traders Workshop, part of the price action video series. And today's lesson is on chart patterns. There are 10 chart patterns that every trader needs to know. And these chart patterns repeat themselves over and over and over. I tend to look at chart patterns on a 4-hour, 8-hour, and daily chart. So a chart pattern is a shape within a price chart that helps suggest what price might do next based on what it has done in the past. So chart patterns are the basis of technical analysis, and it requires a trader to know exactly what they are looking at as well as what they're looking for. So the first one is we're looking at a euro dollar, and today's non-farm payroll numbers actually helped us out on this trade. This is called um, a symmetrical triangle. And we connect the swing points from the top and the bottom, and ideally we would like to have stochastics oversold when there's a break, and that's what happened there. And then the next step is target. So let me just remove this for a second. So I count the number of pips from the swing high all the way down to the swing low of this triangle, and I see that the pip range is about 166. So that's essentially is my target around that. Doesn't have to be exactly at 166 pips. So I'll take my measurement tool and draw it from where it broke all the way up here. And notice it's already up to 155 pips. Here is another symmetrical triangle, this time on the pound USD. And the entry is, again, we're using a 4-hour chart. When price closes above the trend line, we enter a trade, and we're going to target the number of pips from this swing high to this swing low. It's about 166 pips, 167 pips. So that's our target. So far, pound dollar has put in about 90 pips, so it still has about 66 pips to go before it finds resistance. The next chart pattern is called a double top. And we see one here on the same pair, pound USD. So the way we trade a double top is there's our double top. Price needs to break below the bottom to confirm the double top. Once this candle closes, count the number of pips from the swing low to the swing high. That's about 89 pips. That's our projected target. As soon as this candle closes below, we take our trade, we short, and we target 87 pips. I'll take my measurement tool. Excuse me, I'm having a hard time grabbing that. And there it is, 88 pips. And notice after it hit its projected target, stochastic is oversold, and a bullish candle appeared. The other chart pattern is either a double bottom or triple bottom. Okay, and there we have it right there, triple bottom. And then we have the swing high, and we connect these candles. This is also called a wedge pattern. Okay, so triple bottom, wedge pattern. Again, count the number of pips from the bottom to the top. That's about 100 pips. That's our target. So as price breaks above, you can wait for a pullback or take the trade when the body closes, and you calculate 100 pips. And this thing went up 176 pips, even higher. But that's our target. We don't care if it went up any higher. Okay? Again, we're using a 4-hour time frame. Okay, we have another chart pattern called a descending wedge or a descending triangle. This is a wedge, but it's a descending wedge. Then notice price closed above the trend line. We enter a trade. Our target is the number of pips from this swing high to the swing low, 286 pips. So I calculate how many pips from the break, or when it pulled back, 286, and this thing went all the way up to 300 pips before it pulled back. So again, descending wedge, count the number of pips from the swing high to the swing low, close to 300 pips. Once price breaks the trend line, then you can calculate your target. And from anywhere here, it went up around 300 pips. The next chart pattern is called a head and shoulder pattern. And we have back-to-back head and shoulder patterns here. So here, price rallied, came back down, broke above the resistance, rallied, right? Came back down, did not rally, just failed to break above this. So that creates a head, two shoulders, and a neckline. Once price breaks below the neckline, you take your trade. Notice how price came back up, retested the trend line, the neckline, and it just failed and turned around and headed south. The next thing I do once I'm in the trade, and remember your stop loss is always above the shoulder. So the trade is down here, your stop loss above the shoulder, and your target is, count the number of pips from the neck to the head, that's about 230 pips. And there it is. It went all the way down to 318. Okay. Now we have another one here, which is an inverted head and shoulder pattern. Same head and shoulder pattern, but it is inverted. So we have a shoulder, and we have a neckline right there. Count the number of pips from the head to the neckline, about 218 pips. That's our target. Price broke, came back down to a support. Never broke the trend line. 200, it went all the way up to 222. It kept going up, but we're not concerned about that. As long as it hits our target, we're fine with that. So again, that target was what? About 215 pips, and that's our target, 215 pips, okay, right there. This next one is called a pendant or flag, and usually is a continuation pattern. So let me make this a little bit bigger. It's easier to see. So price rallied, came back down, rallied, came back down, got stuck in this range, and then what happened? It broke above the trend line and then continued. So count the number of pips, take my measurement tool from the inside of that pendant. I'm sorry, I'm trying to draw this. Go from here to here. It's about 75 pips. That's my target. Take my trade. When price breaks above the trend line, target 75 pips. It went up 124. We're not concerned how far it went up as long as it hit our target of 75 pips. Okay. Sorry if that was a little messy. I'm just doing this in real time and I'm not preparing. All right, now these are one of my favorite trade setups. Notice how price came back down once and twice, and each time it gave us a bullish candle. That's how you can tell that this triangle, symmetrical triangle, is going to work. Okay, whenever price comes back down to a support level, creates a bullish candle, comes back and hits it again twice, and we also have sort of like a positive divergence on stochastics. Price breaks above, again count the number of pips from the inside of this triangle, 158 pips. That's our target. We're not concerned if it continues to rally. We just want to capture our 158 pips. And there it is. It went all the way up to here. Okay. So that concludes our lesson on chart patterns. If you'd like to learn more on how to trade these patterns, you can sign up for our course or join our live trade room Monday through Friday from 9 a.m. to 11 a.m. Eastern. Thanks for watching. I'll post the website details in the bottom of the YouTube video. Have a good weekend. Thanks for watching.